CFA Level 1 Practice Questions. Learning Module, Analysis of Income Taxes. Topic: Differences between accounting profit and taxable income. The liability for income tax payable that appears on a company's balance sheet is calculated using accounting profit and the statutory tax rate, B, taxable income and the applicable tax laws, C, accounting profit adjusted for permanent differences. Correct answer, B. Accounting profit, pre-tax income from financial statements, is for financial reporting, calculated using accounting standards, IFRS or US GAAP. Taxable income is for tax reporting, calculated using tax laws and regulations for tax returns filed with authorities. These two numbers are almost always different due to temporary and permanent differences. Income tax payable is based on what you owe tax authorities, not what accounting standards say. Income tax payable is the actual liability owed to tax authorities for the current period. This liability appears on the balance sheet as a current liability. Income tax payable equals taxable income times applicable tax rate. This represents the real cash obligation the company will pay to the government. Taxable income starts with accounting profit but is adjusted for temporary differences, permanent differences, tax-specific adjustments such as special deductions, credits, and rules unique to tax law. Temporary differences, timing differences that reverse over time. Examples: depreciation method differences, warranty expense timing, bad debt timing. Create deferred tax assets or liabilities. Also must be adjusted when calculating taxable income. Permanent differences, items that are never the same for book versus tax. Examples: fines, non-deductible, municipal bond interest, non-taxable, certain meals and entertainment. Affect the effective tax rate but don't create deferred taxes. Must be adjusted when reconciling book to tax income. A, incorrect. Using accounting profit in the statutory tax rate to estimate tax payable is incorrect. C, incorrect. Accounting profit adjusted for permanent differences is incomplete, ignoring temporary differences like depreciation and revenue recognition timing, which also affect taxable income. A company's income statement reports a profit before tax, accounting profit, of $10 million. Its income tax expense is $2.5 million. The company's income tax payable for the period is $3.0 million. The most likely explanation for the difference is that the company's A, taxable income was higher than its accounting profit. B, taxable income was lower than its accounting profit. C, statutory tax rate was 25%. Correct answer, A. Income tax expense versus taxes payable basis. Accounting profit, income before taxes, is reported on the income statement in accordance with prevailing accounting standards. Taxes payable are calculated based on the company's taxable income subject to income taxes under the tax laws, and appear as a liability on the balance sheet. Income tax expense reported on the income statement is an aggregate of its income tax payable and any changes in deferred tax assets and liabilities. Taxes payable, $3 million, is greater than income tax expense, $2.5 million. It results in a deferred tax asset. Deferred tax asset, DTA, is created when the tax paid is higher than the tax expense recognized on the income statement. This situation arises when taxable income is greater than accounting profit. Specifically, deferred tax assets arise from deductible temporary differences. A DTA represents taxes that have been paid but have not yet been recognized on the income statement, expected to be recovered from future operations. B, incorrect. Lower taxable income than accounting profit results in lower income tax payable due to a smaller tax liability. C, incorrect. The statutory tax rate set by law applies to taxable income. Differences between income tax expense and payable arise from taxable income and accounting profit, not the tax rate. Topic: Deferred tax assets and liabilities. A company capitalizes and amortizes development costs for accounting purposes over 5 years. For tax purposes, the entire cost was deducted in the period it was incurred. At the end of the first year, the carrying amount of the development cost asset is $800,000, while its tax base is $0. The company will most likely recognize a deferred tax liability, B, deferred tax asset, C, permanent difference. Correct answer: A. The carrying amount of the development cost asset, $800,000, is greater than its tax base, 0. This creates a taxable temporary difference because the company has reported less expense and higher profit for accounting than for taxes so far. In future periods, as the asset is amortized for accounting, this difference will reverse, leading to higher taxable income and a future tax obligation. A deferred tax liability represents the future tax payments the company will owe as this temporary difference reverses. B, incorrect. Deferred tax asset arises from deductible temporary differences, not applicable when carrying amount exceeds tax base. C, incorrect. Permanent differences affect accounting profit but not taxable profit, or vice versa, and do not reverse over time. Temporary differences, however, eventually reverse and result in deferred tax assets or liabilities. A company had previously recognized a deferred tax asset. New information indicates it is no longer probable that the company will have sufficient future taxable profit to utilize the asset. The company should A, establish a valuation allowance against the asset, B, reverse the previously recognized deferred tax asset, C, perform an impairment test on the asset. Correct answer: B. The recognition of a deferred tax asset is fundamentally allowed only to the extent there is a reasonable expectation of future profits, against which the asset can be recovered or utilized. If a deferred tax asset was recognized previously, but there is sufficient doubt about the economic benefits being realized, meaning it is doubtful that future economic benefits will be realized from a temporary difference, the treatment differs based on the accounting standard used. Under IFRS, an existing deferred tax asset would be reversed. Under U.S. GAAP, a valuation allowance would be established to reduce the amount of the deferred tax asset to the amount that is more likely than not to be realized. Unless stated explicitly under U.S. GAAP, CFA is based on IFRS. The appropriate action is to reverse the previously recognized deferred tax asset. A, incorrect. This is the procedure required under U.S. GAAP, not IFRS, when the realizability of the DTA is doubtful. A, incorrect. This is the procedure required under U.S. GAAP, not IFRS, when the realizability of the DTA is doubtful. A company purchases equipment for $15,000. For financial reporting, it uses the straight-line method to depreciate the asset over 10 years. For tax purposes, it is allowed to use the straight-line method over 6 years. Assume a salvage value of $0 for both. At the end of the first year, the company's deferred tax liability is closest to. Assume a tax rate of 30%. $300, B, $450, C, $750. Correct answer: A. Temporary difference created by using different useful lives for depreciation for tax versus accounting purposes. Depreciation based on financial reporting for accounting purpose. Historical cost $15,000. Useful life 10 years, straight line, $0 salvage. Accounting depreciation equals $15,000 divided by 10 equals $1,500. Depreciation based on tax reporting for tax purpose. Historical cost $15,000. Useful life 6 years, straight line, $0 salvage. Tax depreciation equals $15,000 divided by 6 equals $2,500. Asset values at the end of year 1 based on financial reporting. Carrying amount equals historical cost $15,000 minus accounting depreciation $1,500 equals and $13,500. Asset values at the end of year 1 based on tax purpose. Tax base equals historical cost $15,000 minus tax depreciation $2,500 equals $12,500. Temporary difference is the difference between the equipment's carrying amount for accounting purposes and its tax base for tax purposes. If tax base is higher, temporary difference equals tax base minus carrying amount. If carrying amount is higher, temporary difference equals carrying amount minus tax base. In this case, carrying amount is higher. Temporary difference equals $13,500 minus $12,500 equals $1,000. When carrying amount is greater than tax base, this results in a deferred tax liability. When tax base is greater than carrying amount, this results in a deferred tax asset. In this case, carrying amount is greater than tax base, so it is deferred tax liability. Deferred tax liability equals temporary difference times tax rate. Deferred tax liability equals 1,000 times 30%. Deferred tax liability at the end of the first year is closest to $300. A company reported income tax payable of $4 million for the year. During the year, its deferred tax liability increased by $1.2 million, and its deferred tax asset increased by 40 cents million. The income tax expense the company should report on its income statement is closest to A. $2.4 million, B. $4.8 million, C. $5.6 million. An increase in a deferred tax liability, DTL, indicates that the financial accounting income tax expense was higher than the regulatory income tax expense, taxes currently paid. Therefore, an increase in DTL increases the total income tax expense. Lower net income. An increase in a deferred tax asset, DDA, indicates that taxes have been paid but not yet recognized on the income statement. Therefore, an increase in DDA decreases the total income tax expense. Higher net income. Income tax payable, current tax, $4.0 million. Increase in deferred tax liability, DTL, plus $1.2 million. Increase in deferred tax asset, DDA, plus 40 cents million. Income tax expense equals $4.0 million plus $1.2 million minus plus 40 cents million. Income tax expense equals $4.8 million. The income tax expense the company should report on its income statement is closest to $4.8 million. In the current year, a company's deferred tax liability increased by $300,000. This change most likely indicates that during the year, the company A. reported a higher accounting profit than taxable income. B. reported a lower accounting profit than taxable income. C. had permanent differences that increased its tax burden. Correct answer, A. A deferred tax liability, DTL, represents future tax payments the company will owe. DTLs arise from taxable temporary differences, where accounting profit exceeds taxable income. When accounting profit is higher than taxable income, the company pays less tax now but will pay more tax later. The increase in DTL means the company is recognizing tax expense on the income statement that is not yet payable to tax authorities. When accounting profit exceeds taxable income, it creates or increases a deferred tax liability. The company reports higher pre-tax income on financial statements than on the tax return. This means tax expense, based on accounting profit, is greater than tax payable, based on taxable income. The difference accumulates as a DTL representing taxes deferred to future periods. Current year. Company pays lower taxes because taxable income is lower. Future years. Company will pay higher taxes when the temporary differences reverse. The DTL of $300,000 increase means the company deferred $300,000 divided by the tax rate in tax payments. Example. If tax rate is 30%, the temporary difference is $1 million. $300,000 divided by 30%. Scenarios creating higher accounting profit in deferred tax liability. Tax depreciation is faster, higher early deductions than book depreciation, straight line. Revenue recognized earlier for accounting purposes than for tax purposes. Example. Long-term contracts using percentage of completion for books but completed contract for tax. Expenses deducted later for tax purposes than recognized for accounting. Example, warranty expenses recognized when sale occurs for books but deductible when paid for tax. Be incorrect. Lower accounting profit than taxable income creates deductible temporary differences. This situation creates or increases a deferred tax asset, DTA, not a DTL. The company pays more tax now than the accounting expense, creating a future tax benefit. This is the opposite scenario from what an increasing DTL indicates. See incorrect. Permanent differences never reverse and therefore create no deferred taxes. They affect the effective tax rate but not deferred tax accounts. Permanent differences cause a permanent divergence between book and tax treatment. Since they don't reverse, there's no future tax consequence to recognize. A company that prepares its financial statements under U.S. GAAP reports the following deferred tax information. Year 2 deferred tax assets, $1,500,000. Year 1 deferred tax assets, $1,200,000. Year 2 deferred tax liabilities, $900,000. Year 1 deferred tax liabilities, $1 million. Year 2 valuation allowance, $300,000. Year 1 valuation allowance, $350,000. The overall effect on year 2 net income from the changes in these deferred tax accounts is closest to A. A. $250,000 increase. B. $350,000 increase. C. $450,000 increase. Correct answer, C. Changes in deferred tax assets equals year 2 DDA minus year 1 DDA. Change in deferred tax assets equals 1,500,000 changes in deferred tax assets equals year 2 DDA minus year 1 DDA. 1,200,000 equals plus 300,000 an increase in DDA reduces taxable income, which increases net income because fewer taxes are paid now, and the benefit is recognized in net income. Changes in deferred tax liabilities equals year 2 DTL changes in deferred tax assets equals year 2 DDA minus year 1 DDA. Year 1 DTL. Change in deferred tax liabilities equals 900,000 changes in deferred tax assets equals year 2 DDA minus year 1 DDA. 1 million equals negative 100,000. A decrease in DTL reduces the deferred tax expense, which increases net income because the company is paying less tax in the future, and the reduction is recognized now. Changes in the valuation allowance equals year 2 valuation allowance minus year 1 valuation allowance. Change in the valuation allowance equals 300,000 minus 350,000 equals negative 50,000. A decrease in the valuation allowance means the company is recognizing more of its deferred tax assets, which increases net income because the company now expects to realize more of the tax benefit. Net effect on net income equals changes in DDA minus changes in DTL minus changes in valuation allowance. Net effect on net income equals plus 300,000 minus negative 100,000 minus negative 50,000 equals plus 450,000. Topic: corporate income tax rates. Global Parts Incorporated, domiciled in country X with a 25% statutory tax rate, Also operates in country Y, 20% rate, and country Z, 35% rate. This year, its profit before tax was $1,500,000 in country X, $800,000 in country Y, and $700,000 in country Z, assuming no other reconciling items. Global Parts Incorporated's effective tax rate is closest to at 25%, B 26%, C 28%. Correct answer, B. Global Parts Incorporated's effective tax rate is 26.0%, calculated by dividing the total tax expense of $780,000 by the total profit before tax of $3 million. Which of the following statements accurately describes a key difference between the effective tax rate and the cash tax rate? A. The effective tax rate is based on cash taxes paid, while the cash tax rate is based on the income tax expense reported on the income statement. B. The effective tax rate is used for cash flow forecasting, while the cash tax rate is used for earnings projection. C. The difference between the effective tax rate and the cash tax rate typically results from changes in deferred tax assets and liabilities. Correct answer, C. The difference between the effective tax rate and the cash tax rate typically results from changes in deferred tax assets and liabilities. Effective tax rate, ETR, equals income tax expense divided by pre-tax income. Cash tax rate, CDR, equals cash taxes paid divided by pre-tax income. Deferred tax assets are liabilities arise from temporary differences between accounting rules and tax laws. These adjustments create timing differences, for example, recognizing revenue earlier for accounting but later for tax purposes. The ETR includes deferred tax impacts, while the CDR reflects only actual cash payments. Example: if deferred tax liabilities increase, ETR will be higher than CDR because the income tax expense includes the non-cash deferred tax expense. A. Incorrect. The error lies in confusing the source of the effective tax rate, ETR, and cash tax rate, CDR calculations. B. Incorrect. Effective tax rate, ETR, is used for earnings projection, while cash tax rate, CDR, is used for cash flow forecasting. An analyst is reviewing the following data for Kelson Incorporated. Year 3. Earnings before income taxes $85 million. Total provision for income taxes $22 million. Year 2. Earnings before income taxes $78 million. Total provision for income taxes $21 million. Year 1. Earnings before income taxes $95 million. Total provision for income taxes $26 million. Kelson Incorporated's effective tax rate was highest in A. Year 1, B. Year 2, C. Year 3. Correct answer, A. Effective tax rate equals total provision for income taxes divided by earnings before income taxes. Effective tax rate was highest in Year 1, 27.4%. Relative to its effective tax rate on foreign income, Techno Global Incorporated's effective tax rate on domestic income was A. Lower in each year presented, B. Higher in each year presented, C. Higher in some periods and lower in others. Correct answer, A. Effective tax rates for domestic and foreign income are calculated and compared across 3 years. Techno Global Incorporated's effective tax rate on domestic income was consistently lower than its effective tax rate on foreign income for 3 years. A company is fined $200,000 by a regulatory body for environmental violations. For financial reporting, the fine is recognized as an expense on the income statement. According to the tax laws in its jurisdiction, such fines are not deductible for the purpose of calculating taxable income. This treatment will result in a deferred tax asset, B. Deferred tax liability, C. Permanent difference. Correct answer, C. Permanent difference is a disparity between accounting profit and taxable profit that does not reverse over time. It occurs when an item is recognized in one set of financial records, accounting, but never in another, tax. In this scenario, the fine is recognized as an expense on the income statement for accounting purposes. However, for tax purposes, the fine is not deductible. This means the fine affects accounting profit but will never affect taxable profit, creating a permanent difference. Since the difference is permanent, it does not lead to the creation of deferred tax assets or liabilities. These would only arise from temporary differences that are expected to reverse in the future. A. Incorrect. No deferred tax asset can be created because the fine is not tax deductible. B. Incorrect. Deferred tax liability arises from taxable temporary differences, not non-deductible expenses like fines.